Gold just did something it's not supposed to do. It didn't climb. It didn't break out slowly. It detonated. In global markets, gold blasted past $4,730 an ounce. In India, it crossed 1,52,000 rupees for 10 grams. That's a 63% surge in a single year. The strongest move since 1979. Silver went even further. One session, up more than 5%, $94 globally, 3 lakh rupees per kilo domestically, 70,000 rupees added in just 11 trading days. Now stop for a second. Markets don't move like this unless something underneath is breaking. This isn't a story about traders getting excited. This is a story about trust evaporating. And if your savings, salary, or future plans depend on money behaving normally, this already affects you. Because here's the paradox no one explains on the price chart. Gold is screaming panic while the system says everything is fine. And that contradiction is where this story really begins. What you're watching didn't start with gold. The price explosion is just the surface. Underneath it is a specific trigger that markets are struggling to price in real time. According to the content, the shock came when the United States threatened to weaponize trade against its own allies. A proposed 200% tariff on France, paired with similar threats aimed at Germany and the UK, tied to disputes involving Greenland. That's not a rumor, that's the catalyst the market reacted to. Here's why that matters. When the issuer of the world's reserve currency starts using tariffs like a pressure weapon, uncertainty doesn't stay contained. It spreads across every asset priced in that currency. Investors don't wait for clarity, they run from unpredictability. Notice what's happening here. This wasn't sparked by inflation data, not by an earnings report, not by a central bank meeting. It was triggered by policy threats delivered publicly, fast, and without guardrails. Now watch how this reframes the move in gold and silver. This isn't about chasing returns. It's about escaping rules that no longer feel stable. And once markets start pricing chaos instead of numbers, the reaction gets a lot more extreme. Here's the claim that changes how you read the entire rally. This market isn't just overheating, it's malfunctioning. Because while prices on the screen are screaming all-time highs, the physical system underneath is starting to jam. According to the content, refiners are delaying payments to dealers by 7 to 10 days. That alone is a red flag. In a normal market, settlement is fast because confidence is high. Delays mean stress. But here's the detail that really matters. Refiners are offering to buy silver at $15 below spot. Read that again. Spot prices are exploding upward, yet the people handling real metal are paying far less than the quoted price. That's not bullish strength. That's intermediaries refusing to absorb risk. This creates a paradox most people miss. On paper, silver looks like it's soaring. In the real world, liquidity is thinning, spreads are blowing out, and inventory risk is being quietly pushed downstream. Notice what's missing from the headlines. Nobody is talking about this disconnect. Nobody is explaining why a record price doesn't mean easy selling. And when price and plumbing stop matching, markets don't stabilize. They snap. Now watch how fast this imbalance starts to spill into public behavior. The next signal doesn't come from charts. It comes from people. Because once a market breaks internally, the pressure doesn't stay hidden for long. It leaks into behavior, and right now that behavior looks uncomfortably familiar. According to the content, dealers are reporting their fourth highest week in history for order counts. Volume is up 40% in a single week, not from institutions, from individuals. Here's the part that should slow you down. People are liquidating retirement accounts, 401k plans, long-term savings, all to chase silver. At the same time, high school acquaintances with no history in metals are suddenly asking how to buy. That's not organic interest, that's fear of missing out spreading socially. This is the classic late-stage signal. When participation shifts from patient buyers to panicked newcomers, Price stops reflecting value and starts reflecting urgency. But here's the flip. This wave isn't happening in isolation. It's colliding with a system that's already under strain. So instead of calming the market, this surge is amplifying the stress. And that's when things stop behaving normally. Next, watch what happens when policy turns that panic into something even more explosive. Here's where the story stops being emotional and turns structural. Because while retail panic is accelerating, policy decisions are actively making the situation worse. According to the content, Washington State imposed a nearly 10% sales tax on bullion starting January 1st. The result was immediate. Buyers didn't stop purchasing. They fled. Customers are now driving 3 to 4 hours into Oregon just to avoid the tax. That's not theory. That's capital physically moving to escape friction. Local bullion shops in Washington are being hollowed out while Oregon dealers are overwhelmed. Same metal, same demand, completely different outcome, purely because of regulation. This is what capital does when it senses punishment instead of protection. Now notice the contradiction. Governments say these policies don't matter, that people will adapt, but the market already did, instantly, quietly, without permission. And this isn't just about taxes, it's about trust. When rules change abruptly, people stop optimizing for efficiency and start optimizing for survival. Here's why that detail changes everything. Once buyers learn they can bypass the system, they don't unlearn it. They tell others. Behavior spreads faster than policy can react. And while this is happening at the retail level, something much larger is beginning to strain above it. Because now even the biggest dealers are starting to say no. Now watch the system hit its first hard limit. Because when even the largest dealers start rationing, it means demand has outrun the machinery that supports it. According to the content, APMX has introduced a minimum purchase requirement of $500 for online orders. Even more telling, buybacks now require a minimum of $10,000. That's not how retail is supposed to work. Sellers don't raise barriers when business is healthy. They do it when operations are overwhelmed. This isn't about greed, it's about capacity. Minting, packaging, shipping, all of it is under strain from a 40 to 50% surge in volume. The pipes can't widen fast enough. Here's the uncomfortable implication. Silver has always been called the poor man's gold, but when you can't buy less than $500 at a time, access itself becomes restricted. Scarcity stops being theoretical. It becomes logistical. Notice what just happened. Without any official announcement, without any emergency declaration, the market quietly started closing doors. This is where the story flips. Because once access is limited, behavior changes permanently. People rush sooner. They hoard harder. They stop waiting for pullbacks. And that pressure doesn't disappear. It rolls upward, straight into the global monetary system. Now let's bring this back to you, because this isn't just a story about metals or dealers or governments. It's about how pressure in the system lands on ordinary people first. When prices move this fast, everything tied to them starts to feel unstable. Your savings don't stretch as far, big purchases feel riskier. Waiting suddenly feels like a gamble instead of a plan. According to the content, people aren't buying gold and silver because they love metals. They're buying because cash feels less predictable. When someone drains a retirement account to chase silver, that's not speculation. That's anxiety translated into action. And even if you're not buying metals at all, you still feel it. Higher premiums, longer delays, fewer options, the sense that you need to decide faster than you're comfortable with. This is how systemic stress shows up in real life, not as a headline, as a constant low-level pressure that pushes people into decisions they wouldn't normally make. If this feels familiar, say so in the comments, because the most important part of this story isn't who's panicking. It's why the system keeps putting people in that position in the first place. And that mechanism is what we need to understand next. Here's the unsettling part most coverage skips. This keeps happening because the system rewards spectacle over stability. When power is exercised through surprise tariffs announced on camera, policies flipped overnight, rules enforced unevenly, markets stop responding to fundamentals and start responding to fear. Fear moves faster than data, and fear doesn't need confirmation, according to the content. This is why capital isn't just rotating between assets, it's fleeing the dollar itself. Analysts point out that gold still makes up less than 0.2% of U.S. investment portfolios. That's tiny, and it means even a small shift out of bonds and into gold creates outsized moves. This isn't a bubble dynamic, it's leverage. The gold market is small compared to the debt market, so when confidence cracks at the top, pressure concentrates at the edges. Here's why that matters. Systems like this don't fail all at once. They hollow out quietly, while prices send warning signals that get dismissed as noise. And once those signals are finally acknowledged, the adjustment is never gentle. Which brings us to the next phase, already forming: what happens when the biggest players stop watching and start moving. The shift already happened. Most people just didn't notice. Because this cycle isn't being driven only by fear at the edges anymore. It's being reinforced at the center. According to the content, central banks have doubled their gold buying since 2022, from a long-term average of 500 tons a year to nearly 1,000 tons annually. That change didn't come out of nowhere. It came after Russia's reserves were frozen. That moment sent a message no press conference could soften. Assets you don't physically control can be turned off instantly. Here's the key detail. Gold held domestically has no counterparty, no switch, no permission required. That's why central banks are treating it differently now. Notice what this does to the market. When institutions with infinite time horizons start buying, they don't panic sell. They absorb supply, quietly, permanently. This creates something retail doesn't see, a floor. So while headlines obsess over daily volatility, the biggest buyers are locking metal away from circulation. That changes the entire risk profile of the market. And once that supply is gone, it doesn't come back easily. Which raises a far more uncomfortable question. What happens when investment demand collides with industrial necessity at the same time? This is where silver stops behaving like a side character. Because unlike gold, silver isn't just a store of value, it's an industrial input. It goes into electronics, energy systems, and infrastructure that can't simply pause because markets are volatile. According to the content, demand for silver has surged faster than gold, pushing volumes into historic territory. Here's the problem. Supply can't respond quickly. Silver production is inelastic. You can't turn on a new mine because prices spiked last month. So when monetary demand slams into industrial demand at the same time, pressure builds fast. That's how silver tripled from around $30 to over $90 in a compressed window. Not because of hype alone, but because the market structure couldn't stretch anymore. But now comes the tension. Analysts warn silver is stretched. A 30 to 35% correction is possible if geopolitical pressure eases. That's the risk nobody wants to talk about while prices are vertical. This is the danger zone. Silver rewards speed on the way up and punishes hesitation on the way down. So the question isn't whether silver is important. It's whether this move resolves through continuation or through violence. And the answer depends on what happens next. Now zoom out just one step further, because one of the clearest stress signals isn't coming from New York or London. It's coming from the gap between global prices and local reality. According to the content, the spread between international spot prices and domestic landed prices in India has blown out to 12 to 13,000 rupees. Normally that gap sits closer to 6 to 7,000. That doubling doesn't happen in a calm market. It means metal is harder to source locally than global prices suggest. Logistics are strained, import friction is rising, and local demand is overwhelming the system faster than it can adjust. Here's why that matters even if you don't live in India. When domestic markets decouple from global benchmarks, it's a sign the pricing mechanism itself is under stress. Arbitrage stops working smoothly, premiums replace efficiency. Notice what this tells us. Even if global prices pause, local prices don't necessarily follow. Scarcity becomes regional, pain becomes uneven, and that's how instability spreads quietly. Not through crashes, but through gaps. Gaps that force people to pay more, wait longer, or go without. Now watch how this same pattern starts appearing in Western capital flows. Because the next shift isn't retail, it's institutional. Here's the move that changes the timeline. For most of the rally, Western institutions stayed on the sidelines. In 2024, prices rose while ETFs bled metal. That told you who wasn't buying, but according to the content, that flipped in 2025. ETF inflows surged by roughly 500 tons. At the same time, prices were climbing. That synchronization matters. It means pensions, endowments, and portfolio managers finally stepped in, not to trade volatility, but to rebalance risk. This is slow capital. It doesn't chase headlines. It moves when something structural no longer feels optional. Here's the fork in the road forming now. One path is cooling. If geopolitical pressure eases and policy stabilizes, prices could correct hard without breaking the longer trend. The other path is continuation. If uncertainty compounds, institutional inflows don't stop, they accelerate. Neither outcome is guaranteed, but momentum already exists. Allocations are being discussed, models are being adjusted. The next reweighting decision is closer than it looks. And once those decisions are made, they don't reverse quickly, which brings us to the final question this market is asking. What kind of world are prices preparing for next? Here's the insight that ties all of this together. This isn't just a metals rally, it's a rehearsal. Prices aren't predicting one event. They're adjusting to a world that no longer behaves inside clean rules. Debt keeps growing, policy keeps surprising, power keeps fragmenting, and markets are learning to price that reality before it's officially acknowledged. According to the content, projections already reached toward $4,900 for gold into 26, but the number matters less than the reason. This move is being driven by forces that don't reset easily. Once trust erodes, it doesn't snap back on command. That's why this story doesn't end with a top or a bottom. It continues with positioning, with who adapts early and who waits for clarity that never fully arrives. The real question isn't whether gold or silver go higher next. It's what other assets haven't caught up yet. If you want to stay ahead of that shift, follow for the next layer of this analysis.